It's one of the most common questions investors have, which is better, growth or value investing? So, what's the difference between the two investing styles, and which one delivers the best results for your portfolio? On this IBD Explains, we take a look at the differences between growth and value investing. Here with me to help break things down is IBD's personal finance and management editor, Matt Krantz. So, Matt, what are the differences between growth and value style investing?
That's a great question, and it really depends on who you ask. The definitions aren't official per se, but people have different meanings of what they think they mean to them. For most people, growth investing is stocks that are really expanding quickly. So fast-growing companies, companies whose profits are just taking off, just like, these kind of exciting stocks that we all love to read about. Value stocks tend to be cheap stocks. Some people think they're slow growing, but that's not necessarily the case. They're usually just ones that people don't want to pay a whole lot for, and so they're considered to be value.
Right. And let's dive deeper then into each investing style. And what are some of the key elements of growth investing?
Yeah, so IBD is kind of the master of growth stock investing. All the metrics that we have here are what you really want to be paying attention to if you're interested in growth stocks. So relative strength, which tells you how fast the stock is growing relative to other stocks. EPS rank. We love high EPS ranks because they show that the profits are growing much faster than the rest of the market. And the composite rating is another great thing that brings it all together. That's the key to growth investing, is kind of monitoring you. If you're going to pay up for a stock, that's okay, but you just want to make sure it's growing fast enough to justify the price you're paying.
And do you have an example of like what a quintessential growth stock would be?
I think right now the great example is Nvidia. So Nvidia is growing like crazy. It's the second fastest growing stock in the S&P 500 over the next 2 years compounded. The earnings are on fire. Every time they report, they say, you know what, we're actually doing better than we thought. So it's just classic. And it trades for 44 times book value, meaning if you were to liquidate that company, it's trading for 44 times what you would get if you sold off the company's bits and pieces at an auction. That is just unbelievable. To give you some perspective, the S&P trades for about 1 times book value. So it's so expensive, but it's growing, so it's okay.
And what about value investing? I know that is often associated with Warren Buffett, but what are the basic components of stocks that fall into that category?
There's a number of different ingredients that go in. They're mostly valuation metrics. And my favorite, just because it's clean, is price to book. So basically, how much are investors willing to pay for the assets that are on this company's book? So if you were to liquidate the company, how much would you be willing to pay for its bits and pieces? And value companies typically go for 1 times book or even less. But there are some gyrations to it. They go up and down. I mean, sometimes they take off and people pay a little bit more. Financials, people pay about 1.7 times book value. And sometimes they even cross over. So you might have like a bank that gets really popular and people start paying up for it. And it can actually become a growth stock. And if you watch the indexes, they kind of bounce back and forth. That's another interesting kind of quirk, is if you're investing in growth and value, if you want only value, you have to invest in an index as, like they usually call them, like pure value. So it only puts in cheap stocks, not ones that are crossing over. So that's another kind of key to look at when looking at value stocks.
Well, you just answered one of my questions if value stocks could ever become growth stocks. But when thinking about value stocks, what's sort of the classic example there?
Yeah, I was thinking about that. I think it's mostly, I say financials, because people just don't pay up for them usually. They're slow and steady. They, like JP Morgan, trades for about, I think, 1.8 times book, something like that. So it's a slight premium. Another good example would be the automakers like Ford. Ford actually trades for 1.1 times book, so almost exactly the same as the S&P 500. So those are the types of things I think that are value stocks.
Now, one of the most important things investors will key on is performance. So, what are the differences between growth and value investing when it comes to returns?
That's a great question. I wish I had a really good answer for you. It really depends. So if you look long term, so if you go all the way back to the 20s, value stocks do outperform slightly by a little bit. They go up about 10.5% on average a year, whereas growth stocks are more like 10. Lately, they've been a little bit lower, but lately it's been the opposite. The Nasdaq's been on fire. Growth stocks are blowing away value. A lot of people that own value are getting frustrated. Like energy stocks have been languishing for a long time. They're starting to pick up now, but they've been languishing. Financials have been languishing. So now it's growth. It usually swings back and forth, but as a general rule of thumb for investors, it's really good to own both because they tend to kind of shine at different points of time. So when growth is running, value tends to lag, and when value is running, growth tends to lag. So if you own both, you're playing no matter what.
And just to wrap up, what can help investors figure out which style is best for them?
Yeah, I think everyone kind of starts off as a growth stock investor. It seems like it because you hear about exciting stocks and you want to jump in. And I think what happens if they don't follow the rules, if they don't read Investors Business Daily and they don't follow the right things, they get burned. It's really easy to get burned on growth stocks because they're so highly valued. If Nvidia makes even the slightest mistake, that stock's going to go down a lot. So I think over time, people kind of get burned enough times that they either switch to value or they add more value, they add to diversify. So I think the answer is kind of really you want to be both. You just want to buy the best in breed no matter what, and IBD can really help you do that.
Well, Matt, thank you so much for your insights today. We appreciate it.
Thanks for having me.